All right, what did Craig have to say?
Craig says he shifted 100% to cash only yesterday.
So we're recording this on Friday the 10th.
So that was the day, possibly the day before.
9th or the 8th.
And he says that Blind Freddy, the world's greatest investor, can see there's a huge meltdown on the horizon. Gold is at a record high. The stock market is massively overbought. USA is virtually bankrupt. My super's made 7% since the 1st of July. Well, good on you, Craig. And now I've shifted to interest only for the balance of the financial year, and I'll recess then. I assume that means cash invested to earn interest.
Yeah.
What is everyone else's thoughts on the economy outlook? Well, let's just deal with the 3 points that he raises as the sign that Blind Freddy should see that the crash is coming, and then we come back about the wisdom of his reaction to all of this. Yes, gold is at a record high and has significantly grown in the last year. When you look at it over the longer term, gold is up about 95 times, or at least it was the last time I looked. It's probably changed in the last few days. 95 times since you could first buy it in 1971. So the US came off the gold standard in
5?
2.
2?
And it was illegal for people to own it for quite some time. And the price sort of ran up steadily and peaked in 1980 and then dropped off really quickly. So it hit this peak for like a week in 1980. And in inflation-adjusted terms, it's only just past that peak. So about a year ago, it passed that peak in inflation-adjusted terms. So gold is an important part of most people's portfolios, and most Life Sherpa Invest portfolios will have 10% allocated to gold.
I have got a Life Sherpa Invest portfolio, and I trust there is an allocation to gold.
And the rationale for that is not because it's gone up 45% in the last year. It's been there for over a decade, and it's been there because of the way it behaves relative to everything else. And you get that without giving up returns. So over that period I just mentioned, from 1971 to today, gold has delivered about 8% annual returns, which compares the S&P 500 in US dollar terms at about 11. So if you ignore the dividends, they're neck and neck. And so that's why gold's important. Yes, it's run up quite significantly. I'm not sure that's a sign of, and back to this moment, I'm not sure that's a sign necessarily of an impending doom, but it's more a function of central banks rotating their reserve holdings. Much as, Australia sold ours out in, was it the Keating eras we sold all ours? Or Howard?
Sure. Not that old, Vince.
And
I look it, but I'm not.
A lot of central banks have moved back in, particularly the Chinese. So although when I walked down Martin Place the other day, and there was a queue outside ABC Bullion.
Was that to buy, or are they people selling Nana's old jewellery?
You couldn't tell. ABC, this actually made the papers today.
Yeah.
And ABC Bullion were quoted saying mostly buyers, but some sellers.
Right, okay.
But I wouldn't be reading into the recent spike of gold as the world's about to end tomorrow. Stock market is massively overbought. Well, inflows have been strong. The valuations are not actually overly stretched when you look at the risk-free rate and forecast earnings
But if you
growth.
carved NVIDIA out and some of the big AI stuff, like, sure, that there's probably a discussion there.
Yeah.
Maybe with the Mag 7.
Yeah, so the multiples on the face of it appear high. So if you apply them against the Shiller Cape Index or the Buffett indicator, historically you'd say they are high. But when you look at the current risk-free rate and what earnings growth might look like, they're toppy, but I wouldn't say they're particularly stretched. And your third point about the US being on the verge of bankruptcy, well, heads up, the US cannot go bankrupt. It is in control of producing US dollars. And before you Keynesians have a go at me in the comments, the the printing money doesn't necessarily lead to inflation. Government deficits are simply the flip side of private sector wealth. You can't have one without the other. And the US has been running a deficit for more than 40, maybe 50 years. Certainly when I did my MBA in 1986, my thesis was on what they called a twin deficit problem back then. And everyone thought the world was going to end in 1986. And
Did it?
And it didn't, actually, surprisingly enough. And, of course, the US has run 2 surpluses in the 40 years between it. So I wouldn't say that the US has got a lot of problems, but the debt's not one of them, that the US government could wipe that out tomorrow by turning the printing button. Part of the reason why it doesn't, part of the reason why governments don't do that is because the markets need a safe place to park money, and it forms the basis of the risk-free rate. So you cannot get rid of the bond market, which is dominated by governments. The market needs the bond market, and the US is not going bankrupt anytime soon. Now, does that mean the market might not fall 30% tomorrow? No, I don't have a crystal ball, and we don't do predictions at Life Sherpa. Is it more likely to fall than it was yesterday or the day before? I don't think so. But it will fall 30% someday. I just don't know when. In fact, I don't know how old Craig is, but let's say he's close
55.
Close to retirement. He's got 40 years of life to go, and he will see 3 or more 30% falls in that time. In fact, every 2 to 3 years, we have a double-digit fall. So let's not get too hung up about this.
I think it's important, Vince, to note that if there is a 20 or 30% fall in markets, like, number one, have a look what happened in April with the tariff crash that lasted.
The Trump tariff tantrum.
Yeah, which lasted 10 minutes. Just because an indice may fall 20% in a matter of weeks, most of our listeners' portfolio is not in 100% equities, 100% international equities. So we need to be conscious of the fact that we've got balanced portfolios, and if a market falls 20%, it doesn't mean your whole log in and see your account fall 20%.
Yeah. But that assumes that people are diversified. And if you've spent as much time on Reddit or Facebook as I have, you will know the preponderance of 100% large cap equity portfolios. The classic VAS VGS VEU, that's 100% large cap equities. And that's all highly correlated. So that's not a balanced portfolio by any stretch of the imagination.
I saw a thing on Instagram the other day, and I'll take a screenshot and overlay it in the YouTube. Big trouble. Data trend screams recession louder than any economist, and it's looking since the last 20 years, the top Google searches in the USA.
Not that we have a long data series for that, time series for that.
That's right. So the spikes, you probably can't see it, but either way, it's like all of this stuff spiking over the last year. Sell my house fast, give car back, borrow against stock, borrow against life insurance, sell my Rolex watch, and bankruptcy lawyer. They've all spiked. And maybe there is a discussion, Vince, you've heard of Wall Street and Main Street. Like, is there a detachment from the two at the moment?
Yeah, there is arguably. I mean, if you look at the consumer spending data, both here and in the US, it's out of whack with capital markets. Craig lists 3 indicators that concern him. I mean, the one that concerns me more than anything is the preponderance of geared funds being launched. That is a sure sign of the fag end of a boom. Now, when the taxi drivers, or I guess today it's Uber drivers, in the 20s it was shoeshine boys, when they start spruiking stocks, you get this sort of thing. I went to my local 24-hour restaurant the other night for
Were you at City View on Circular Quay or whatever it was called?
No, this is a bit more suburban than that. I won't name names because I'll probably embarrass the guy behind the counter. But I was wearing my shirt because I just come from a meeting, and he said, "Well, what do you do?" And I said, "I run a financial advice business." And all he wanted to do was talk about stocks and how he was a legend in investing. And I just had to nod and go, "Yes, mate." They're the bigger signs.
Yeah, I jumped in an Uber in Portland when we were at FinCon, and the guy's like, "Oh, what are you doing?" I'm like, "I'm at a conference," because I hate saying it's like a money conference and all that. He goes, "Oh, I trade options," and I'm thinking, you must be very good if you're doing Uber.
That's right.
Anyway, I asked a couple of people on LinkedIn, and I didn't put Craig's name or anything on LinkedIn just to respond. Peter Diamantidis said, "Trying to outsmart the market is like trying to outsmart the ocean. If you paddle against every swell, you'll wear yourself out and still end up right where you started or even further back. The ups and downs aren't something to avoid. They're part of the movement that makes the progress possible. The very motion that makes you uneasy is also what creates the lift that delivers your return. Without that rise and fall, there is no forward momentum at all. The risk is what the return rewards. The trick isn't to fight the tide, it's to hold steady on the board, knees bent, and let the natural movement work for you." Another Neil said, Neil Benson, "This is what happens when people who still listen to Robert Kiyosaki."
Who's predicted 10 of the last 2 recessions.
That's right. And Jeremy Taylor on LinkedIn, he's not a connection, but he's put on my post. And this is a good quote from Peter Lynch.
Yeah, I love this quote.
"More money has been lost by investors preparing for corrections or trying to anticipate corrections than has ever been lost in corrections themselves."
It's absolutely true. Because the problem with this approach, even if you're right, being right once isn't enough. You've got to be right. You've got to be right about getting back in as well. And that's where most people fall down. So if you think Craig's probably old enough to remember 2008, but if you think back to 2008, right, we had the big drop in September 2000. Well, we had a gentle drift down through late 2007, early 2008. We had the big fall in September 2008. And then it kept slowly drifting. It didn't actually bottom till 2010. So, would you have jumped back in through 2009 and compounded your problem? Or would you have waited till 2011, 2013 when you'd have missed out on the first 20% of the correction of the recovery? So it's a really tough gig to pull off. And you asked me a few months ago, what are the 3 attributes of a great investor? And I said something along the lines of patience, humility, and opportunity. And this is where humility matters. Yeah. If you start believing that you know more than the market, you are heading for a fall.
Yeah.
And
so in bringing this to a point, if you're out there and you are reading crap online, you're seeing Instagram posts that I see and I've just shared, and we don't react to anything in our life out of fear, be it investing, be it relationships, be it anything. You start doing things out of fear, things will go wrong. The second thing is you need to have a strategy for your financial life. Now, this could be a good time to call your super fund, log in, see how you're invested. Use this very time to think, all right, I need to learn what I'm invested in and just get dialed in. You probably don't, if you've got your super set up and you've not touched it for a million years, it's not going to be in 100% growth anyway. And I would hypothesize if you are 60 or even 55, you are still going to need that money to be put to work for the next 20 or 30 years. Now, what does it matter if my account fluctuates a little bit here and there over the next 12 months when I look back in 20 years' time? It's a blip. It's a non-event. We just need to zoom out. When in doubt, zoom out.
But it is, if this is your gut reaction, it's probably a sign that your portfolio is not aligned with your risk profile.
Mm.
And risk profile is a function of your tolerance for risk, your capacity to recover from it, and your need for risk. And you've got to take all three of them into account. And so, when it comes to investing, at the risk of sounding like a broken record, that growth's important.
You look like a broken record as well.
But if some is good, more isn't always better. And you've just got to align it to your needs.
Yeah.
And if you feel the need to go to cash, it's probably because you're in the wrong portfolio in the first place.
Vince, I've never met somebody who has, over a period of even 15 years, tried to do this and actually had a success story. They usually end up staying in cash for too long.
Yeah, that's usually the problem.
Because you don't have the stones, you're just still waiting, you're still waiting, you're still waiting. And the market will move on and you'll miss the boat. Now, do what you want, but this is a good idea to get financial advice. If you're one of our angry followers who don't like us because we are pro financial advice, call your super fund, get some free advice from them on your portfolio. Just get engaged and don't do anything dumb. Because if you start dicking around and moving your super to cash and I'll put half here and half there, it's only going to end in tears. And if you're still working, Craig, if the market is correcting and it does pull back a little bit, guess what? Your employer contributions are buying in at a lower unit price anyway. So there's that. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.